I'm in Rome this week, and I got really sick, so I'm gonna have to cut my trip short. I'll be heading back to Canada on Tuesday. Was able to get a flight out in a couple of days. So this week will be rather short. I just haven't had the time. I don't know what I got, but man, did it knock me out. Last 2 days, barely could get out of bed, and every time I did, that chill you get where you're just freezing for no reason? That's what I got going on. Anyways, let's get to it here. Link for Discord is now up. If you go to markmeldrum.com and set up a free account, you'll find the link to get you to Discord. It is now up. Also on May 12th and 13th on Discord, we're going to be offering a pre-exam office hours blitz. 5 sections of level 1. I'll be doing the derivatives, the fixed income and economic sessions, and I'll be doing the sessions at 2 different times, one to appeal to North America and one to appeal to the UK and Europe. So you don't have to worry about staying up in the middle of the night. I'll get up in the middle of the night and do it. So that's May 12th and 13th. That's free. Even if you're not a CFA markmeldrum.com subscriber and you either have no provider or another provider, I'm doing this for free. All you have to do is go to markmeldrum.com, open up a free account. You'll find the link to Discord there. And then once I see you show up on Discord, I'll assign you a role. We'll be using the stage feature, which allows you to raise your hand. That's not a very good hand. Let me do that again. There you go. Which allows you to raise your hand. That looks like Bart Simpson, doesn't it? And ask a question, and I can hear your voice, as opposed to just typing a question in a comment box. Or you can use the comment section as well. Also, AI for finance. The first videos in this series will be up May the 12th, and this will be in applied analysis. And I'll be using the coal industry to demonstrate how to generate a precursor report to help you understand the coal industry. And then we'll go through a number of competitors, and we'll see how quickly we can get through some competitors just by feeding it to AI. And I'll show you a bunch of really cool tools that will give you different output depending on, the type of person you are, whether you like to read something, whether you like to watch something, or whether you like to listen to something. Well, let's go through some of the economic reports we had last week. GDP was the first one, came in at negative 0.3. GDP now had it at negative 0.4. That was their forecast. All the data that makes up GDP is out by the end of March, so it should be fairly exact. The second quarter GDP now is 1.1, down from 2.4. And this is how it breaks down to get to the negative 0.3. Consumption, investment, government spending, and the trade balance. We can see the trade balance really took away from growth. There it is right there. Imports took 5% off of growth, but you had inventory bills and down here a lot of money spent on equipment. The consumer, as far as goods, 0.11. So we can't really say that consumers were front-running the tariffs in the department stores, but the stores were certainly front-running the tariffs in terms of their inventory. Service is still strong, 1.1, but this is the U.S. The U.S. is different, very different than most other economies in the marginal propensity to consume. One thing that the U.S. can say quite clearly we're number one at is in spending. Most Americans will spend every penny they make, and the really only way that you get spending down is separating people from their paychecks, which is not happening. At least the data is suggesting that it's not happening. If we look at the jobs report, both the household and the establishment survey agree. 177,000 added based on the establishment survey. Where is it? 436,000 added based on the household survey. This is interesting. You had population increase of 174,000, labor force increase of 518,000. Participation rate increased by 0.1. That would make sense if you have your labor force growing by faster than your population. Your participation rate would have to increase. Unemployment rate held at 4.2%. For the establishment survey, private payrolls 167, goods 11,000, all in construction. Services added 156,000. Transportation and warehousing up 29,000. With all of these imports and all of this warehousing for inventory, that doesn't seem so surprising. And education and health up 70,000, but that has been a trend for some time. Average weekly hours 34.3, no change there. Average hourly earnings up 0.167, hardly anything there. Let's have a look at. Let's see if I can find it here. We'll find the report for. Here it is. I'll just bring it on the screen. This is PCE. It comes in the personal income and outlays report. This is for March. Change in monthly consumer spending. Consumers were front-running something, and that was motor vehicles and parts. Look at that, 56.6%. This is the change in consumer spending, 56.6 billion. But gasoline and energy goods, negative 30 billion. So that's kind of like a little tax cut. Tariffs are a tax hike. Energy prices dropping are a bit of a tax cut. Let's look at the price indexes here. PCE price index 0. This is month over month. PCE price index excluding food and energy 0. Let's go down to one of these subcharts where it gives us the price indexes. Where is it? Here it is right here. And we'll look at this bottom one over here. This is market-based PCE. Market-based means no imputed prices at all. It's only what we can actually see in the marketplace. If you look at market-based PCE, negative 0.1, excluding food and energy, 0. But look at all the negative signs here. Durable goods, negative 0.5. Non-durable goods, that's goods is negative 0.5. Durable, negative 0.1. Non-durable, negative 0.7. Services, 0.2. And this is PCE, excluding food and energy, 0. Food, 0.5. There's a culprit right there. Energy, goods, and services, negative 2.7. Market-based PCE, negative 0.1. I said this a while ago. I don't think inflation is going to be our problem. And I don't think it is a problem. This lines up well with the CPI, Consumer Price Index report that we've had. Personally, I think the Fed can cut. There is no reason, with inflation not here, there is no reason to continue to have rates in the 4%, the overnight rate in the 4% range. I think they have permission to cut. Let's look at rates and yields over the last week. Up, not a lot, but just the wrong direction if you are long duration. May 7th, 3 days from now, FOMC, and the weight is all the way to 0, which I think is right. Even though I think they can cut, they have permission to cut. King Trump, or should I say Pope Trump? Pope Trump has now made that impossible, because if they do cut, then it opens up a conversation about Fed independence. So unfortunately, as much as it could cut, they're probably not going to. ISM services we get in 1 day. Balance of trade for both U.S. and Canada. This is for March, we get in 2 days. That is going to be an ugly number for the U.S. based on what we saw with third quarter GDP. 4 days, non-farm productivity and unit labor costs. If we can keep non-farm productivity greater than 2%, inflation really isn't going to be a problem. The higher you can get productivity, the more inflation is just not going to be a problem. Market pricing out more rate cuts for the rest of the year, the next 3 quarters. Nothing. Oh, that's a terrible color there on white, right? There we go. Nothing in Q2. 51 for the whole year. That's 2 cuts in 6. Call it 2 cuts in 5 because this, I think, is off the books for now. That's going to be a 0. And then Q1, another 18.5. So roughly about 3 cuts over the next 8 meetings. This will get us into the next year, so that covers 8 meetings. What else we got? China, balance of trade, we get in 4 days. This is for April. That's going to be interesting. The numbers we're getting up here for balance of trade are for March. We hadn't had the day of liberation at that point. You just had the fear of the day of liberation. And Q1 imports, 5%. That's huge. That's going to be an ugly number for balance of trade. This is April. And this is China. This will be an interesting number. Jobs report for Canada in 5 days. Reverse repo still hanging in there. 147 billion. Reserves 3 trillion. TLT week over week down 1.3%. It looked like it wanted to get some elevation earlier in the week. Broke 90, a little bit above 90, but then got scared and ran away. SPY 2.92%. Where are we going here? I mean, nothing is solved. You still have 10% tariffs across the board. You do not have 200 trade deals, no matter what they tell you. You do not have 200 trade deals. I'd be surprised if you even have 1 trade deal. What you probably have is an agreement to enter into a trade deal at some point. So I don't even think that exists. And you still have the Orange King, who, God forbid the cameras are not on him. He'll do something crazy to get those cameras back on him again. So I just don't know where we're going with that level of uncertainty. I'll talk about it when we get to SPY. Dollar index had some rebound here, up 0.935, now sitting over 100 point. I think it's 100.2, 100.25, somewhere around there. Real yields all slightly higher, and not much change on the break-even rates. Call it, pretty much unchanged. You had a little bit of widening on all of the OASs except the riskiest. Had a contraction there, but not enough to talk about. Look at corporate bond issuance. Year to date is down 1.9% year over year, but this was March over here. This is April. Look at the drop off going into April. Last April was 143.6 billion. This April is 112.46 billion. IG 115 down to 102. High yield 27 billion down to 8 billion, and convertibles. Convertible showed an increase here, 800,000 to 1.36, but you have this big drop off from March to April, and we're below last year's level as well. Typically, companies target a specific debt equity ratio. So as the valuation of the companies increase, the level of debt also increases to keep the same debt equity ratio. So over time, you expect to see debt increase over time. Issuance down 1.9%, and you have this drop April over April, and again, that is a big drop March over April. Mortgage rate 6.76, still stubbornly high, down 5 basis points, which is not bad, I guess, because the 10-year increase. So for this to be down, I guess that's not so bad. But again, this is Thursday. The 10-year rate we have on the previous screen was for Friday. This is a Thursday close, May 1st. We don't have the Friday close. Okay, let's move on to SPY now. 2 stories here. Kind of 3 stories, really. Let's start with the forward operating earnings, 271.54. Look at the progression downwards here, 277.32, week after 275, 272, 271. This is not a matter of 20 cents, 30 cents down each week. These are big revisions downwards. Also with the 271.54, where are you getting that from? And this is bottom up analyst forecasts. Well, with a record number of companies suspending guidance, which I thought would happen in a situation like this, where are you getting your numbers? Analysts typically target the guidance. If a company's saying, well, we don't know, what are you putting in? So I don't even know if that 271.54 is reality or just pure model at this point. I seem to think 260 is in the cards. Second story, where do we think we're going? 21 times forward earnings. 21 times, again, 21 times forward earnings. And the meme stocks right back at it again. So the excesses of the market are still here. And look at this third story. Look at this, just la-di-da-di-da, up we go every single day. Now, mind you, there were some good earnings in there, Microsoft and Meta, but there were a lot of companies with questionable earnings, especially when it came to consumer goods. Wendy's, McDonald's, both of them, not very good at all. This is 20.94 up from 20.24. Combination of the market going up and earnings going down. Not a good combination, but it doesn't seem to matter. We are now sitting at 7.5% below the all-time high hit on February 19th when there were no tariffs, no anti-U.S. sentiment at all. And here we are. IWM out of bear market territory, down 17%. Same with IJR, small caps, both out of bear market territory. And triple Qs out of correction territory, 9.59. So just some things that are just contradictory. Earnings estimates on the way down, but with what guidance? Multiples on the way up because your market is going up, but with a much more hostile condition post February 19th than you had pre-February 19th. It doesn't add up. So I guess the question is, am I still short this market? Yes, I am. I did say I would like to see it get to 560, 565 again so I can really hit it. So I am short this market. 94 companies reporting this week. Sector Spider has 90, actually has 89 because it lists both classes of shares for Time Warner. I'm not going to go through the list. My voice is probably not going to make it. I think I'm at the end of what I can do here. I know this is a short one with not a lot of commentary, but I don't think I have it in me. Not my best work. I'm sorry about that. Hopefully next Sunday I'll be able to do better.